All right, well, welcome back. We're on Module 12, down on page 23 towards the bottom, and we're going to pick up variable life. Now, it's important to know the differences among whole life, or universal life, and variable life. So what we need to do is just to kind of set the stage. Now, remember, this is not the insurance exam. And so keep things very, very simple. A lot of you have already taken your insurance exams, and you know a lot more than you need to know. All right, so just because, like I say, there are all kinds of twists and turns, variations and permutations on these things. Keep it simple. Okay, it's kind of like it with accounting. You don't need to be an accountant to pass this test. You do need to know how a balance sheet is laid out, okay? Or an economist. You don't need to be an economist, but you do need to know what the Federal Reserve Board does. So keep it simple, all right? And you can get too complex. Basically with whole life, okay? Whole life is set up where, here you go. You take a certain number of dollars every month and you put it into the insurance company, which then puts it into this black box, and they say that when you die, that you'll get X number of dollars, your beneficiaries will get X number of dollars. Okay? So you say, well, what's the black box look like? And they say, if you'll pay X number of dollars every month, then when you die, your beneficiaries will get this much money. You say, well, what's it doing? You say, if you'll pay this number of dollars every month, your beneficiaries will get this much money when you die. They say, well, do I have any choices? They say, if you put it, you guys get the idea, okay?
Right.
That's it.
No.
Okay? Somebody said, you know, we need to dig into this thing and see what the deal is. And they kind of deconstructed it. And when interest rates were sky high, they said, this is absolutely ridiculous. You know, you can buy term insurance, invest the rest even in money market funds, and come out a lot better. And so the insurance industry took just a huge hit. And they said, we've got to do something to make things a little bit more visible. So what they did was that they came up with universal life. Okay? Universal life is the same basic idea, except that you can see what's going on. Okay? So you've got a transparent box that your money goes into. Okay? And again, this is where you've got, what do you pick up with universal life? A little bit of flexibility. Okay? That's basically, for our purposes, what you pick up. Because if you see that you're getting enough to where, oh look, you know, there's enough money in my bucket that's inside there now that I can miss a payment. Okay, so except July. Okay, because I need my money in July for some reason, I don't know. Okay, that's cool, you can do that. And then another thing you can do is that you can scale this up and down. Now again, there may be some, some insurability situations, da-da-da. This is not the insurance exam. Keep it simple. You pick up a little bit of flexibility. Okay? And then folks said, well, you know what? Really, it would be really, really cool if we could self-direct what goes in there. Okay, well then let's come up with variable life. Now, for our purposes, variable life is going to be variable whole life. So what you're going to do is you're going to put X number of dollars in per month. The thing is that you're going to put it into not a black box and not a transparent box, but you're going to put it into that bucket marked with your name on the side, and it's going to be, I guess it ought to be question mark X, but your death benefit will go up, you know, if you have good performance. Okay? So that's it, but still, like I say, you're looking at variable whole life insurance. All right, now if this doesn't make sense to you, you need to go back and look at the video on the variable annuities, because that's where we came up with this little illustration. But with that big overview, let's go ahead and look at the outline. Whole life has fixed premiums. They're required at fixed intervals. It has a guaranteed minimum death benefit. That's also going to be the maximum death benefit, because what you get is what you get. That's it. There's no investment choices for the cash value, which the cash value, of course, is basically, how it works, you guys know this, is they overcharge you when you're young and then undercharge you a little bit when you're old, and then finally at age 100, typically, everything comes out even. Okay, so you don't have any investment choices for that cash value, the overpayments, when you're young. But because of the fact that the insurance company is in control of the whole thing, and they're making all the guarantees, they're not counting on you for any decisions or any performance or any marketplace, then you can actually borrow out the entire cash value. If you have a question on whole life, that's probably the most probable one right there. Okay, now it may be combined into, which of these can the insured borrow out the entire cash value? 1, 2, 3, and 1, 2 type answer. Okay, universal life, you pick up flexibility in premium amounts and payment dates. There's a possible guaranteed death benefit. There are no investment choices. Again, the insurance company is doing that for you, but it is it's like in a plexiglass box that you can see what's going on. There's more visibility, there's more flexibility. That's it. Again, since the insurance company is in control, they're going to allow you to borrow out that entire cash value. But variable life, you have that minimum guarantee, but your death benefit is going to increase as the performance exceeds, there's our old buddy, the heir. Now, let me tell you, step back and look at that. One of the things about the heir, okay, is that the heir always has to do with the ultimate purpose of the product. Here's what I mean. When I'm in, remember our little model for the annuity, if I'm on the accumulation side, the heir doesn't make any difference at all to me, because the purpose of an annuity is to provide a lifetime retirement income on the annuitization side. That's where the heir kicks in. Likewise with life insurance, I put money in, it's in there, it has to be. But where does the heir make a difference? It's on the death benefit. That's the purpose of the product. So the heir always has to do with the ultimate purpose of the product. And if you start introducing the heir into those preliminary steps, it's going to throw you off completely. All right? So, variable life, like I say, the death benefit can increase if your performance exceeds the heir. Now, what you can do is that you can actually create illustrations on these things, and you can illustrate up to 12% performance per year. Let's figure this out. The 50-year average of the S&P 500 has been about 10%. If you illustrate at 12%, then that's not a 2% overperformance. That's a 20% overperformance. That's pretty aggressive. So if you illustrate at 12, what you need to do in any case is to balance out your illustration of performance with zero performance. What happens if nothing happens? Give me the best case, give me the worst case. Okay? And oh, by the way, if you average 13%, God bless you. You're just lucky as a dog. But I can't illustrate that. But like I said, you can illustrate up to 12%, balance it out with zero. The death benefit is reduced by any loans. That makes sense. You got to pay your loans. In fact, in your will it says, say all of my just debts should be paid, or however they phrase it. Attorneys. And that's one of them, so they'll just take it out of the death benefit. The death benefit is reduced by any past due premiums, because why? This test doesn't know about variable universal life. Okay? You may have a question. If you do, I wouldn't hold my breath for it, but if you do, just combine that flexibility with the fact that you can make the investment choices. Okay? So if you have past due premiums, it's going to reduce your death benefit. And then you have FIFO surrenders, first in, first out. First in is going to be your money, which has already seen tax. Therefore, it's going to be a tax-free withdrawal until such time as you've exhausted the sum of your premiums. So let's do the little side-by-side comparison here, because this is very important to keep in mind. Here's an annuity. Okay. You've got a certain amount of principal, which is after tax, a certain amount of earnings, which is pre-tax, and you've got the same thing over here on insurance. This is the sum of your premium payments, your principal, after-tax dollars, your earnings up here have not seen tax. What you're going to do here on the annuity side is you're going to withdraw this way. Okay? But with an insurance policy, you're gonna withdraw this way. So your loans that you take, or your withdrawals, excuse me, loans are always gonna be tax-free because you gotta pay them back. Okay, you're not really withdrawing, you're just, what they'll do is that they'll take a portion of this and they'll put it over into basically an escrowed account for you, and that's your collateral for a loan, just like going down to the bank, okay, borrowing against a CD or something. It's not, but like I say, very comparable. But if you make a withdrawal, you're gonna take those principal dollars out. So I'm taxable here until I hit this point. But the thing is that I'm tax-free here on insurance until TIL, there we go, hard to spell, until I reach that same point. Okay, so there's the difference between the two. All right, let's see, the death benefits are included in the estate of the deceased. Our estates contain everything that we own, okay? So if you want it to be not included, you've got to, like, set up some type of a trust or something like that, way beyond the scope of this test, okay? But for our purposes, it's going to be included in the estate of the decedent. The death benefits pass income tax-free to a beneficiary. That's just a characteristic of life insurance in general. All right, and then it's invested in separate accounts. It increases, it increases with, I lost my place here. The variable life death benefits are calculated at least annually. Now I'm going to come back and revisit that point, because if you're tested on that, there's really a pretty easy way to remember the different intervals. So variable life cash values, okay? What are we looking at here? Let's redraw that bubble, because even though it's now an insurance policy with a death benefit, it's still the same situation, okay? Here's Bob, and he's putting money into this life insurance policy, and there's his separate account, okay? Goes in there. He still has choices here, okay? He can still direct it. And so, what's going to happen is that less the insurance costs, it's going to go to his cash value. Now, because of the fact that he's in things that can basically tank and go to nothing, there is no guarantee that he's going to have anything there in his pot. So there's no guaranteed minimum on cash value. But the thing is, look at what does increase it. Every time that he sends him a check, there's more money that goes into the pot, so it's going to increase with his premiums paid. It's going to increase or decrease with the performance. Again, these things, they look a whole lot like mutual funds. They're not. But what happens with your mutual fund if you're on a systematic investment program? Okay? If the marketplace goes up that you're in, whether it's stocks, bonds, a mix, whatever, then that's going to augment the money that you're throwing in. If the marketplace goes down, then it can in fact decrease and make even counteract that extra money you're putting in. It's exactly the same thing here. Okay, it's vested in separate accounts. Those values are calculated daily. Again, we'll revisit those time intervals. It's reduced by expenses and the applicable charges, like it costs money to have insurance, and so they'll take that insurance charge out. Then the owner can only borrow a portion. That makes sense, because see, I can borrow it all if the insurance company is in charge, because the insurance company isn't going to put themselves in a vulnerable position. But if I'm in charge, I could put the insurance company in a vulnerable position where the whole thing could crater and they'd be left holding the bag. So no, on variable insurance I can only borrow out a portion. What portion? That's an insurance test question. I don't know. I don't care. It's just a portion. And then those loans are tax-free. Talked about that already. Cash value is calculated monthly. Okay, so let's get these things into perspective here, okay? If I really wanted to know how much my mutual funds were worth, how often would I check the paper? Every day, right? Yeah. So my separate account looks a lot like a mutual fund, let me value that daily so that my nervous Nellies will be able to check and see what it's worth every single day. But now in the aggregate, how much is in my mutual fund account? Well, I can do all the math if I want to, but you know what's a lot easier? To wait till my statement comes in, right? And statements are going to come in monthly. So cash value is going to be monthly. But now let me ask you this. How often are you going to die? Once. That's it. Hopefully it's not going to be this year. But just in case it is, or just in case it's next year, let's calculate that death benefit annually. Let's calculate it just in case that does happen this year. Okay? So like I say, on a need-to-know basis, that's when they're calculated. And that's, to me, that it makes a lot of sense that that's the way to remember it. Okay, so there are sales charges stated in the prospectus, and maximum of 9% over the first 20 years. 20 years is deemed to be technically the life of a contract. Okay, so 20 years over the life of a contract, 9% over the life of the contract, 9% over 20 years. I've actually repeated myself for test purposes. All right, and then maybe 50% front loaded in the first year. So basically what we'll do is that we'll charge that first year a whole bunch and then drop it down below 9%, but there's 9%. If you take all this out right there, the 20-year period, that's where you wind up, because it's going to, like so. Okay. All right, then let's see, the refund privileges. You've got a 45-day free look. You get everything back. Okay? No surrender, no sales charges, no nothing. Or 10 days after the receipt of the policy if it's longer. So 45 days or 10 days after you get the policy. Afterwards, what you'll get is the cash value plus a partial refund of the sales charges for the first 2 years. Now, force me to remember these percentages or to remember the 2-year period with a partial refund of sales charges. I'm going to remember the 2 years with a partial refund. Because by what I've heard, that's going to be the more likely question. The sales charge in excess of 30% of the premiums paid the first year and 10% in the second year. And after that, you only get the cash value. But again, by what I've heard, the more important thing to remember, because this is getting into insurance test detail, okay? The thing I've heard more than anything else is, over what period of time do you get a partial refund of your sales charges? Okay? And that's going to be the first 2 years, 45-day free look. And then you've got Section 1035 exchanges, okay? Section 1035 exchanges are not taxable. We're going straight from an insurance company to the other insurance company. You can do this with life insurance policies. You can do it with annuities, okay? And it's going to be income tax free as long as it doesn't get your fingerprint on it. Now, if you say, I want all my money out, and then you turn around and take it and give it to another insurance company, then basically what happens is that you get your fingerprint on it. I don't care if you take the check and sign it over to the other insurance company. So you do something like this. Right there, when you touch it, that's a taxable event. Okay? But if the money goes through the ether, like so, then that's a 1035 exchange, and look, we just bounced right over that taxable event. So it's got to go insurance company to insurance company. Okay? It's available for both annuities and insurance, but now here's the deal. You'll need to know you can switch from one to the other. Okay? Which one and which other? You only have 2 choices, so it makes a nice little 4-box grid. So from and to. Life, annuity. Life, annuity. Let's do the easy ones first, okay? You can go from life to life all day long. You can go from annuity to annuity all day long. That just makes sense, okay? But now, let's go on vacation. All right, we've worked real hard. Let's go on vacation. Where are we going to go on vacation? Well, let's see. You know what? You can go to LA. Whether that's Los Angeles or down in Nolens. Okay, I don't know about you, but I can eat a ton of those crawfish. Because I'll say them crawfish. But anyway, be that as it may, you can go to LA. So let's see, I can go life to annuity, but we can't go to Alabama. No, can't go down there, okay? Sorry folks in Alabama, love your state, love the Gulf Coast, whatever, but no. Okay? Can't do that. So, like I say, you can go to LA, life to annuity, but you can't go to AL, okay? From annuity to life. No, here's what the deal is and why you've got that, okay? Is that if you go from life to annuity, you go out of a situation where your beneficiaries are going to receive money tax-free and you can get tax-free loans and FIFO withdrawals, to a situation that is much more desirable for the IRS, because eventually somebody's going to be paying some money, some taxes on some of that money is going to be taken out, okay? But you can't do this because what you're doing is you're going from a situation where the IRS has a payday to where the IRS is not going to have a payday, and they didn't fall off the turnip truck last week. They're not going to miss out on a payday. So that's it, simple. But the way to remember it, let's go to LA. Go on vacation. Don't go to AL. Don't do that. All right. And so finally, switching from variable to whole life, if it's the same cash value, face value, excuse me, no physicals required, you can do so at any time. And if it's in the first 2 years, you do so at an original age. Remember that the insurance industry as a whole is they're conservative tight, they squeak. Okay? And so, not to say it's bad, it's just that's the way it is. And so here all of a sudden you're introducing into a sacred institution, life insurance, that provides for families after someone's death. I mean, you've heard it all, you've used it all, okay? And all of a sudden you're introducing variability into this. Oh my gosh. What if the guy says, oh, what have I done? What have I done? You've got to give those folks an out. So you allow them to switch, like I say. And it's in the first 2 years, even at the original age. So that wraps us up for us on variable life as well. And like I say, you will have some questions on these, so I'd certainly be aware of those. Okay.